Hello traders, in this lesson we're going to talk about the 3 steps to find an entry. So the first thing you want to do is you want to check the overview. You want to look at what the overall market is doing. And to check the overview, you want to use the weekly time frame. You could also use the 2-week and the monthly, but that would be a little bit more complicated. So for this lesson, let's just focus on the weekly. You want to categorize your weekly into 2 factors: historic price action and immediate price action. So historic price action is what happened to the left when you look to the left of the chart, and immediate would be your present price action. So the conclusion here is price is showing bearish signs on both historic and immediate price action. So let's look at a more complex example. So what do you have here? Historically, what you had is a breakup structure right here. And what you could potentially be waiting for is for price to sweep this zone and get back in here so you can start referencing this range. You can start referencing this swing high and this swing low if there is a weekly swing being made right here. Another possibility here is price could start referencing this entire range. So from this swing low to this swing high. And price could react from this demand zone to go bullish. So now let's move this to the side and let's look at the immediate price action. The immediate price action is clearly bearish. You can see this past period was all bearish price action. But the historic price action is telling us that price could potentially go bullish. Why could price potentially go bullish? Again, you have 2 reasons to go bullish. Price could either start referencing the entire range and react of this internal liquidity, which would be your discount, your extreme demand, which would be your discount, or price could sweep this liquidity and turn. So the reason for this is you don't want to sell when price is this low. You want to sell high and buy low. So when price overall is at this specific point, which would be considered as low, you don't want to sell low. So what would you do here? You would wait until you get a bullish signal. What would a bullish signal look like? First off, you can see that price is now rejecting. So now what do you have here? You have your bullish sign. You have a rejection from an extreme, and now you have your bullish sign. So now you can erase this. And now you can determine your bias. So now your bias would be bullish. Again, ideally, you would want an engulf. You would want a strong candle to determine the current price action being bullish. But if you don't get that, you still have higher chances buying here than selling. And that's really the point. And this was now a convincing push. Why is this a convincing push? You have multiple reasons. One, price rejected from this zone. Your second is price closed beneath this swing low, broke structure, but now came back and closed back inside. So now this is two confirmations. And what is the third one? This aggressive push, this aggressive candle. Like I said previously, in this specific example, yes, this was a confirmation. Price was indicating that it wants to go bullish, but it wasn't fully clear yet. This was just simply one rejection. And we know when price visits these extreme zones, whether it's extreme supply, which would be premium, or extreme demand, which would be discount, price usually consolidates. And that's what you had here. Price consolidated for a little bit, accumulated orders, and gave you that aggressive push. So now you should be bullish all the way to when? Your next extreme zone. So price is bullish all the way up to here. And you could potentially get turbulence right here. So to make it simple, this would be your bias. And in the next step, we're going to talk about in which fashion will price deliver to the upside. So the conclusion here, from your directional bias point of view, you want to make sure your historic price action and immediate price action are both in line. By in line, I mean if your historic is bearish, you would want to wait till your immediate is bearish as well. Same thing goes for bullish. If your historic is bullish, you would want to wait for your immediate to be bullish as well. So now for step 2, let's go back to our previous example. So like we said previously, we had a sign here, which we could revisit. That first sign that was kind of a weaker sign, but then we had that big confirmation here, that aggressive move to the upside post a consolidation. So again, we had a consolidation and an aggressive expansion. This would be your extreme zone. Price will come down, consolidate, and then give you that aggressive move. So it's just safer if you wait for it. And a lot of traders just simply don't wait for that move. They'll get in a trade once price touches that zone or once they get that one bullish candle. But ideally, you want to wait for this specific price action. It's drop, base, rally. So now for step 2. What you want to do is you don't want to buy price right here. So let's say you have your confirmation. We're not going to buy price here and get in a trade something like this. Why? Because if you do end up losing multiple trades in a row, it would just be hard to come back from underwater. It will be a difficult time. We want to shrink this entry. And it's not even really about the entry. It's about the entire concept. You want to buy low and sell high. And how would we buy low in this instant, even though we are already low? What you want to do is you want to reference your micro timeframes. So now let's go to the daily. And don't get me wrong, you don't have to go directly to the daily. You can go to the 3-day, the 2-day, and work your way to the daily to find the best price. What you want to see is that down move before the bullish expansion. Where were the orders loaded in? So if you trade order blocks, you would simply mark up this bearish candle. This was the last bearish candle before a bullish expansion. If you trade bases, you would grab this entire zone. A base would be that consolidation before. So you would look at where price consolidated. So price dropped here, consolidated here in a compressive manner, because this would be more of a diagonal accumulation, and then price expanded. So if you trade bases, you would actually mark up this entire zone. You would just mark up all the way from this red candle, which was the bullish order block, all the way down here. That would be the only difference. So whether you trade basic supply and demand or you trade smart money, you'll kind of reach the same conclusion. Let's stick with the order block. So again, if I'm trying to buy low and sell high, in this case, I'm already buying low on the macro, on the higher time frame, which is our overview. Now that I'm getting to the lower time frames, I want to buy low. So again, I wouldn't be buying here just because the bias is locked. That just simply wouldn't cut it. You'd want to wait for a retracement. So understand, after you determine your higher time frame, whether it's the historic and the immediate weekly time frame aligning, you still want to wait for a retracement on the lower time frame, which in this case would be the daily. You'd want to wait for price to retrace and buy that retracement. So again, even on this daily time frame, you want to buy low. So you would spin back the same concept. So you find that point of interest, which would be this order block. You look at the historic price action. What happened? You had a break of structure. So what are we waiting for? We're waiting for price to close back inside of the range and retrace. Once price retraces, we can get in a trade. What happened here? Price is rejecting. So when this happens, all you're simply doing is waiting. You're not jumping the gun. You're like, okay, I'm seeing a reaction right here. Let me get in a buy right here. This would actually, let me get in a buy right here. We're not doing that. We're waiting to buy price low. So just a quick tip. If you are a scalper, once this happens, you could trade bearish all the way down to this point. Now price interacted with your demand. And again, the way you could look at it too is if you even want a better entry, you can get in an entry right here. But if you do trade like this, heads up, you will miss a lot of trades. So if you're waiting to get in price right here, you will miss a lot of trades. But by that way, you are shrinking your stop loss tremendously. So you could be getting in a trade here in comparison to here. But the downside is you will miss a lot of trades. And we will test this out once we're done covering the third step as well. And as far as take profit, pull out your fib, mark up the low and high. Your first take profit would be clearing the immediate high. So that would be your first take profit. Your second take profit is your fair price, and your third take profit is here. So now let's get even more precise and go to step 3. So before we proceed, please make sure you like the video and leave a comment. This will help us continue making these free lessons. Before we go over step 3, make sure you understand that it's not necessary. By not necessary, I don't mean completely disregarded, but do understand that step 3 is for extreme precision. So going back to this example, let's go now to the 1 hour. You could potentially go to the 4 hour as well. It's not as rigid. So first, let's erase this. You can see better. And what do you have here? That contact with our daily time frame pullback. This is where contact was made and price instantly expanded. What we're looking at on the lower time frames is we're looking for that catalyst. We're looking for that signal that will activate everything. A lot of times it's simply a liquidity sweep. It's a fake out. Price will fake out in one direction, make contact, and this whole thing could happen in your zone. So not necessarily that, let's say this is your point of interest where price is retracing to. It doesn't have to happen like this, where liquidity is formed, price sweeps that liquidity and then goes and then reacts. It could all happen inside of this zone too. So what we do here is we're not going to just simply take that sweep. We're going to wait for a sweep break of structure and another retracement. But the difference is now that you are on these super lower time frames, you would take the entry at the top of that micro range. So you would wait for that sweep. Once price absorbs that liquidity, and breaks structure, you would take a trade right here. Once price comes down here and reacts off the breaker block, you'd get in an entry right here with now your stop loss right here. So in this example, you had multiple sweeps. None of them really activated until price reacted off this level. So you can say this is one sweep. Price formed that liquidity, swept, went to the upside, swept again, went to the upside, but there is no break of structure. Not until price swept this liquidity and then broke structure. And what happened once price broke structure? Stretch it out. Now that price broke structure, you'd get in a trade right here. Actually, this would now be your stop loss. And your take profit would be based off your daily time frame. So now let's pick a random pair. You can go Euro CAD or Euro USD. What's another odd pair? We go Euro. Yeah, let's delete any previous drawing. There's no previous drawing. Let's shrink the data. And let's go to the weekly time frame, and let's go back not too far. Like I told you guys in the previous lesson, you don't want to go too far, but you don't want to go too close either, because you might remember the price action. But this is now okay. So on the weekly, always trace your steps back. So you had a rejection here. Let's make this black so we can just simply move it around. You had a rejection here. Now price is at a low. Previously, everything was bullish, but this looks like an internal to an internal trap. So this is where it gets a bit difficult because this could be an area of indecision. Price could be trapped in between these two zones and make a decision. But by looking at how the weekly looks, how the historical data looks, I would lean more towards price sweeping this zone if price is to continue to the upside. So if price sweeps the zone, then we can start looking to go bullish. So I would still consider myself to be bearish. Now let's go on a daily. Let's understand the danger zone. On a daily, you are inside of an order block. So let's see if we can go lower because we can't get a clear view here. So if I'm to take a trade here, which still wouldn't be the best trade. This is a bit rushed, but you'll have to do just fine. I'll take a trade right at this zone. I'll take a sell. So let's see. Let's take a sell. Stop loss right here. Take profit, clear out this zone, and even potentially target that target that we have. Let me move my, oh man, it's too late now. In real life, you would want to take out partials. So once you cleared out this initial area, you would want to take out partials. You want to take out 50% of your position and then let the rest ride out all the way to the bottom. Okay, we would have lost this trade. Now let's go to the weekly and look for more clues. Okay, so now price is, instead of sweeping, price is interacting of internal liquidity with this strong candle to the upside. Let's go on a daily and see if we can catch a retracement. What would be a decent retracement? You do have a base here that was broken, but nothing is clear yet. So let's go on the 4 hour. See if we can get a retracement up to this base right here. Somewhere here. Okay, let me get in a buy. Stop loss right here. Take profit right here. Go back on the daily. Okay, this is where you'd want to move your take profit. You would want to move your stop loss and you would want to take out a certain percentage. You would want to take out 50% of your trade. Hope you guys enjoyed this lesson. Make sure you like, share, and subscribe, and let us know in the comments what lesson do you guys want next.